Hi, welcome to Principles of Managerial Accounting. We are focusing on manufacturing financial statements, and I am Tanya Sanders Kelker, your accounting instructor. Let's get started. So, today we're going to be talking about your financial statements for a manufacturing business. We all know that if you took principles of accounting for financial accounting, you all have already seen financial statements. You're familiar with them. And we're going to go over them, but this time specifically for manufacturing businesses so that we can see the difference in the financial statements for each type of business. All right. So, the main financial statements that you learned about previously were the income statement, the balance sheet, your statement of cash flow, and your statement of return earnings, sometimes called the statement of owner's equity. Now, in any type of business, specifically a service business or a merchandising business, to sometimes consider a product business, these are the four financial statements that you're going to use, and they look the standard way you were taught. But for a manufacturing company, you're going to have these same four financial statements, but the only two that will look different from the other type of businesses will be your balance sheet and your income statement. Plus, we will have a statement of cost of goods manufactured that will be added on just for manufacturing companies only. And that will be the basis of what we'll be talking about today is the balance sheet, the income statement for manufacturing businesses, as well as the statement of cost of goods manufactured. All right. So we all know in manufacturing businesses, cost is king. And with cost being king, we know we have three types of costs. We have direct materials, direct labor, and factory overhead. Now, you should already know how to classify your cost, but in this case, we are looking at where these particular costs go on the financial statements. So, let's start with direct materials. Direct materials are either used or unused. If the direct materials are unused, then they show up on the balance sheet under materials inventory or raw materials. If the direct materials are used, then it is moved over into the manufacturing process. All right, let's move over to direct labor. Direct labor is once you calculate the cost that it costs for direct labor, it goes directly into the manufacturing process. And then I'll show you all what to do with this manufacturing process. But right now, we're going to stick it in manufacturing process. Then you have your factory overhead. Once that number is calculated, it goes into the manufacturing process. Once you have your manufacturing process, you have to determine if it's a work in process, because that's what manufacturing process is. It's more like your work in process, right? So if you are not done, so if it's unfinished, then you're going to move it into your work in process inventory. But if it is finished, it's going to go to finished goods inventory. So on the balance sheet, typically in a service or product or sometimes called merchandising company, you have inventory, and your inventory on the balance sheet is just one account that says inventory. But for your manufacturing company, you have these three accounts: your materials inventory, your work in process inventory, and your finished goods inventory. And we just broke down how and where to put the three different costs from your manufacturing business where it shows up on the actual balance sheet. Okay? Now, we got the balance sheet out the way. Now let's look at the income statement. The income statement will only have one place that will be different from the other businesses, and that is your cost of goods sold. Your cost of goods sold will directly come from your finished goods inventory once the actual inventory has been turned into a finished good, and once you actually sell that finished good. That's when it will show up as cost of goods sold, and you'll document that actual transaction when it's sold on the cost of goods sold area on the income statement. This is just a high overview of what's going on. Now let's break it down so that we can see a specific balance sheet, income statement, and your cost of goods sold, cost of goods manufactured statement. All right, let's start with the balance sheet. Your balance sheet. All right, like we talked about, in a merchandising or product based business, your balance sheet will only have an inventory account or materials account. Usually it say inventory. But with your manufacturing company, now instead of one inventory account, you're going to have three. You're going to have materials inventory, which is your raw material, or sometimes just labeled as materials. You're going to have work in process inventory, sometimes notated by WIP. And lastly, your finished goods inventory. Let's take a peek at some actual examples of what these balance sheets look like. So we're going to look at just the current assets portion of the balance sheet of both a merchandising business or a manufacturing business. Let's first look at the way you've seen the balance sheet previously. You're going to start with your current assets section. You're going to have cash. And in this example, it's $10,000 for this merchandising business. Then you're going to have your accounts receivable, and we're going to say it's $15,000. And you're going to have your merchandise inventory, sometimes just inventory on the balance sheet for $75,000, and then your supplies for $5,000. In a merchandising business, it's just simple addition. You're going to add all of them up. You're going to add your inventory account with all other current assets account to get your total current assets. However, when you look at a manufacturing business, we go a little deeper because we don't only have one inventory account, we have three inventory accounts. So if we're looking at our current assets, we're going to start with cash. And in this example, this manufacturing business has cash of $21,000, accounts receivable of $120,000. And then we have inventories for a total of $121,500 and supplies for a total of $2,000. But we can't move too fast because how did we actually get this inventory's number? This inventory's number is the total of your finished goods, your work in process, and your materials. So we calculated and found out that we had $62,500 worth of finished goods, $24,000 worth of inventories that was stuck in work in process, and then we got $35,000 worth of raw materials that we have not used. If you remember, when we go back to the previous slide, we have our finished goods inventory, which is right here. We had that total, and we had our work in process total and our raw materials total. That raw materials total was any of the direct materials that we did not use. Our work in process inventory was any unfinished material that we started using, or cost that we started using in the work in process for anything that was not complete. And then in our finished goods inventory is all of the costs associated with being finished, with completing a finished good. So then we added those three numbers up together. We got $121,500 and added all the other current assets together, which gave us a total current assets of $264,500. All right. So That is the major difference between a merchandising business and a manufacturing difference. The main section that will look different will be your current asset section. Now let's look at your income statement. All right, your income statement, the major difference is your cost of goods sold versus your cost of merchandise sold. So on your income statement, your merchandise company are going to have accounts that will that are worked out, or formulas that are worked out as such. So you have your merchandise inventory plus your purchases, which will give you the merchandise that you have available for sale. So if you think about that, once you in your product business, once you have in your inventory all of the inventory that you purchased, that's your beginning inventory, your total amount of inventory you have at the start of this reporting period, plus any additional purchased inventory in that period. So the beginning plus the purchases is going to give you your total merchandise available for sale. And then when you want to look at your cost of merchandise sold in a merchandising business, you're going to look at the merchandise available for sale minus your ending inventory at the end of that period, which will give you your cost of merchandise sold. Now, for a manufacturing company, you're going to look at your cost of goods sold. So you're going to look at your beginning finished goods inventory account plus your cost of goods manufactured, which will give you your cost of finished goods available for sale. So your cost of goods manufactured is basically the same as on here that was in your working process, right? And then it's going to give you your cost of your finished goods for sale. And now you're going to look at your cost of finished good available minus your inventory, which will give you cost of goods sold. Okay. Now let's make that make sense, because that was a lot. Let's break it down by actually looking at an actual income statement side by side. Okay. So in your merchandising company, you had cost of goods sold that was determined here. You had your beginning merchandise inventory plus your purchase inventory, which gave you your total goods available for sale. Subtract your ending merchandise inventory, which would give you a total cost of goods sold here. The difference between the merchandise company and your manufacturing company. With your manufacturing company, you have to look at your beginning finished goods inventory account for the time period plus your cost of goods manufactured, and you're going to add those together, which will give you your goods available for sale, minus your finished goods inventory, which will give you your cost of goods sold. This is an example of what it looks like on the income statement for both a merchandising company and your manufacturing company. And to put it all in perspective, in your merchandising company, right before you even look at your cost of goods sold, you're gonna actually have your sales total at the top here, right? So you're gonna have your sales total minus your cost of goods sold, which will give you your gross profit. Okay. In a manufacturing company, you'll have your sales minus your cost of goods sold, which will give you your gross profit. So the only thing that changes is how you determine your cost of goods sold on your income statement. All right. Now, let's go a little deeper into your statement of cost of goods manufactured, because sometimes they won't just give you the number of cost of goods manufactured here. So let me show you how to actually calculate that so that you can always have every number available. To calculate your cost of goods manufactured, sometimes you have to create a statement of cost of goods manufactured. And how you do this is you're going to take your beginning work in process inventory account total, and then you're going to look at your you're going to look at your materials accounts. So of your direct materials. So you're going to look at the beginning in materials inventory account. Then you're going to add any purchases, which will give you the cost of materials available, minus your ending materials inventory, which will give you your cost of direct materials used. Then you go get your direct labor cost and your factory overhead cost. When you add your materials, labor, and overhead, you have your total manufacturing costs incurred. Okay? So then you're going to take your beginning work in process inventory account plus your total manufacturing costs, and that's going to give you your total manufacturing costs incurred, the whole total here. And then you're going to subtract your ending work in process inventory, which would give you your cost of goods manufactured. And let me clear this up. It says the same thing twice. The incurred should only be at the top one. This one should not say total manufacturing costs incurred. It should just say total manufacturing costs. And that will be the total you get. Okay. All right. I hope this was very helpful and help you as a great introduction to knowing the difference between financial statements for manufacturing companies and merchandising companies. Take a little time to go back over it, get clear, and get ready to work some examples so that you can actually know what you're doing. All right, talk to you soon. I am Tanya Sanders Kelker. Y'all have a great day.